The previous section, we analyzed business transactions. In this section, we indicate how these business transactions should be recorded. Rather than using tabular summary like the one we presented for SoftBite, an accounting information system uses accounts. An account is an individual accounting record of increases and decreases in a specific asset, liability, or stockholders' equity item. In its simplest form, an account resembles a letter T and is referred to as a T account. The terms debit and credit mean left and right. These terms do not mean increase or decrease. The act of entering the amount on the left side of the account is called debiting the account, and making an entry on the right side is crediting the account. When the total of the two sides are compared, an account will have a debit balance if the total of the debit amount exceeds the credit. Conversely, an account will have a credit balance if the credit amount exceeds the debit. An account consists of three parts. 1. The title of the account. 2. A left or debit side. 3. A right or credit side. The basic form of the account is shown here. The procedure of recording debits and credits in an account is shown for the cash transactions of SoftBite. The data is taken from the cash column of the tabular summary. Every positive item in the tabular summary represents a receipt of cash. Every negative amount constitutes a payment of cash. In the account form, the increases in cash are recorded as debits, the decreases as credits. The account balance, a debit of $8,050, indicates that SoftBite has $8,050 more increases than decreases. Each transaction affects two or more accounts to keep the basic accounting equation in balance. For example, if assets increase, liabilities or stockholders' equity must also increase. It also follows that for each transaction, the debits must equal credits in the accounts. The equality of debits and credits provides the basis for the double entry system of recording transactions. Under the double entry system, every transaction is recorded with equal debits and credits. The sum of all the debits to the accounts must equal the sum of all the credits. For SoftBite, increases in cash and assets were added on the left side, and decreases in cash were added on the right side. We know that both sides of the basic equation must be equal. It therefore follows that increases and decreases in liabilities will have to be recorded opposite increases and decreases in assets. Thus, increases in liabilities must be added on the right or credit side, and decreases in liabilities must be added on the left or debit side. Debits to a specific asset account should exceed the credits to that account, and credits to a liability account should exceed debits to that account. Asset accounts normally show debit balances, and liability accounts normally show credit balances. Stockholders' equity is increased by stockholders' investments and revenues. It is decreased by dividends and expenses. Investments by owners are credited to the common stock account. For example, when cash is invested in the business, cash is debited and common stock is credited. The common stock account will normally have a credit balance. Retained earnings represent the portion of the stockholders' equity which has been accumulated through the profitable operation of the business. It has been increased by credits and decreased by debits, dividends, or net losses. Normally, retained earnings will have a credit balance. The most common form of a dividend is a cash dividend. The dividend account is increased by debits and decreased by credits and has a normal debit balance. When revenues are earned, stockholders' equity is increased. Revenue accounts are therefore increased by credits and decreased by debits. On the other hand, expenses decrease stockholders' equity, and as a result, expenses are recorded as debits. Expense accounts are therefore increased by debit and decreased by credit. Revenue accounts normally show credit balances, and expense accounts normally show debit balances. Presented is both the basic and expanded basic equation. It shows the accounts that comprise stockholders' equity and the debit-credit rules and effects on each type of account. Study this diagram carefully. Like the basic equation, the expanded basic equation must be in balance. Total debits equal total credits. Journalize transactions. Although it is possible to enter transaction information directly into the accounts, few businesses do so. Practically every business uses these basic steps in the recording process. Transactions are initially recorded in a chronological order in a journal before they are transferred to the account. Companies may use various kinds of journals, but every company has the most basic form of the journal, the general journal. The journal makes three significant contributions to the recording process. 1. It discloses in one place the complete effect of a transaction. 2. It provides a chronological record of transactions. 3. It helps to prevent or locate errors because the debit and credit amounts for each entry can be readily compared. To illustrate the technique of journal writing, the first two transactions by SoftBite are journalized using the first page of the general journal. These transactions were: September 1st, stockholders invested $15,000 cash in the corporation in exchange for shares of stock, and computer equipment was purchased for $7,000 cash. A more detailed analysis of the general journal follows. In taking another look at the standard form of the journal, we find 1. The date of the transaction is entered in the date column. The date recorded should include the year, month, and day of the transaction. 2. The debit account title, that is, the account to be debited, is entered first at the extreme left margin of the column titled Account Titles and Explanation, and the amount of the debit is recorded in the debit column. 3. The credit account title, that is, the account to be credited, is indented and entered on the next line of the column titled Account Titles and Explanations. and the amount of credit is recorded in the credit column. 4. A brief explanation of the transaction is given. 5. A space is left between journal entries. The blank space separates individual journal entries and makes the entire journal easier to read. Post to the ledger. The entire group of accounts maintained by a company is referred to collectively as the ledger. A general ledger contains all the assets, liabilities, and stockholders' equity accounts. The procedure of transferring journal entries to the ledger account is called posting. To illustrate this procedure, let's examine the general journal, and more specifically, the general journal entry to record the stockholders' investments of cash in exchange for shares of common stock. What we want to do is transfer the information in the entry to the ledger accounts. To make this transfer, we follow these steps. Step 1. In the ledger, enter in the appropriate columns of the accounts debited the date and the debit amount shown in the journal. Step 2. In the ledger, enter in the appropriate columns of the account credited the date and the credit amount shown in the journal. Most companies have a chart of accounts that lists the accounts. The chart usually starts with the balance sheet accounts and follows with the income statement accounts. The chart of accounts for Pioneer Advertising Agency Incorporated is now shown. Now let's see if we can use all of the concepts that we have learned to date. We will use the October transactions of the Pioneer Advertising Agency Incorporated. Its accounting period is a month. A debit and credit analysis precedes the journalizing and posting of each transaction. The purpose of transaction analysis is first to identify the type of account involved, and then to determine whether a debit or a credit to the account is required. On October 1st, stockholders invest $10,000 cash in an advertising venture to be known as the Pioneer Advertising Agency Incorporated. The asset cash is increased $10,000, and stockholders' equity, specifically common stock, is increased $10,000. Debits increase assets. Debit cash is $10,000. Credits increase stockholders' equity. Therefore, credit common stock is $10,000. The journal entry to record this entry would be as shown, and the posting of this entry would appear in the ledger using T accounts. On October 2nd, a $1,200 cash advance is received from R. Knox, a client for advertising services that are expected to be completed by December 31st. The asset cash is increased $1,200. The liability unearned revenue has been increased $1,200 because the service has not been rendered yet. That is when an advance payment is received. An unearned revenue, a liability, should be recorded in order to recognize the obligation that exists. Note also that although many liabilities have the word payable in their title, unearned revenue is considered a liability even though the word payable is not used. Debits increase assets. Therefore, debit cash $1,200. Credits increase liabilities. Therefore, credit unearned revenue $1,200. The journal entry to record this transaction would be as shown, and the posting of this entry would appear in the ledger using T accounts. On October 3rd, the office rent for October is paid in cash $900. The expense rent is increased $900 because the payment pertains only to the current month. The asset cash is decreased $900. Debits increase expenses. Therefore, debit rent expense $900. Credits decrease assets. Therefore, credit cash $900. The journal entry to record this transaction would be as shown, and the posting of this entry would appear in the ledger using T accounts. On October 4th, $600 is paid for a one-year insurance policy that will expire next year on September 30th. The asset prepaid insurance is increased $600 because the payment extends to more than the current month. The asset cash is decreased $600. Note, the payments of expenses that will benefit more than one accounting period are identified as prepayments. When a payment is made, an asset account is debited in order to show the service or benefit that will be received in the future. Debits increase assets. Therefore, debit prepaid insurance is $600. Credits decrease assets. Therefore, credit cash is $600. The journal entry to record this transaction would be as shown, and the posting of this entry would appear in the ledger using T accounts. On October 5th, an estimated 3-month supply of advertising materials is purchased on account from Arrow Supply for $2,500. The asset advertising supplies is increased by $2,500. The liability accounts payable is increased $2,500. Debits increase assets. Therefore, debit advertising supplies $2,500. Credits increase liabilities. Therefore, credit accounts payable $2,500. The journal entry to record this transaction would be as shown, and the posting of this entry would appear in the ledger using T accounts. On October 9th, Pioneer Advertising Agency Incorporated hired 4 people to begin to work on October 15th. Each employee is to receive a weekly salary of $500 for a 5-day work week payable every 2 weeks, first payment made on October 26th. A business transaction has not occurred. There is only an agreement between the employer and the employees to enter into a business transaction beginning on October 15th. Thus, a debit-credit analysis is not needed because there is no accounting entry. On October 20th, the Board of Directors declares and pays a $500 cash dividend to stockholders. The dividend account is increased $500, and the asset cash is decreased $500. Debits increase dividends. Therefore, debit dividends $500. Credits decrease assets. Therefore, credit cash $500. The journal entry to record this transaction would be as shown, and the posting of this entry would appear in the ledger using T accounts. On October 26th, employees' salaries of $4,000 are owed and paid in cash. The expense account salaries expense is increased $4,000. The asset cash is decreased $4,000. Debits increase expenses. Therefore, debit salaries expense $4,000. Credits decrease assets. Therefore, credit cash $4,000. The journal entry to record this transaction would be as shown, and the posting of this entry would appear in the ledger using T accounts. On October 31st, Pioneer Advertising Incorporated received $10,000 in cash from Copa Company for advertising services provided in October. The asset cash is increased $10,000, and the revenue account service revenue increased $10,000. Debits increase assets, therefore debit cash $10,000. Credits increase revenues, therefore credit service revenue $10,000. The journal entry to record this transaction would be as shown, and the posting of this entry would appear in the ledger using T accounts. As you can see, every journal entry affects one or more of the following items: asset, liabilities, common stock, retained earnings, dividends, revenues, expenses. By becoming skilled at transaction analysis, you will be able to recognize quickly the impact of any transaction on these 7 items. Prepare a trial balance.